Pull out your bank card right now and look at it. There is a logo on it, a building name, a promise of security, service, maybe even partnership. The language banks use about themselves is always the same. We are here for you. Your financial well-being is our priority. Banking made personal. None of that is true, not in the way they mean it. And the proof is not in some modern scandal or recent corporate greed story. The proof is in who actually built the first banks, why they built them, and who those banks were designed to serve from the very first day. The answer goes back 5,000 years, and the people who built the first banking system were not entrepreneurs, not merchants, not visionaries trying to improve the lives of ordinary citizens. They were priests, and the system they built was designed entirely around their own power, their gods, and the rulers who employed them. Your bank is still running that system, updated, repackaged, rebranded, but structurally the same. The oldest financial records ever found are Sumerian clay tablets from the city of Uruk in Mesopotamia, modern-day Iraq, dating to around 3,400 BC. These tablets recorded grain deposits, withdrawals, and transfers between accounts, not physical grain moving around, just entries on a shared record that everyone trusted. The institution keeping those records was the temple. In ancient Sumer, the temple was not just a religious building, it was the administrative center of the entire city. It owned land, it employed workers, it received offerings of grain, livestock, and silver from the population, and it stored all of it in its granaries and vaults. The priests who ran the temple realized something that every banker since has understood. All that grain sitting in storage was idle. Most depositors would not reclaim their grain for months, so the temple started lending it out to farmers before the harvest, to merchants before a trading expedition, to craftsmen who needed raw materials before they could produce anything to sell. The priests charged for this service. The interest rate on grain loans in ancient Sumer was around 33% annually. On silver, it was around 20%. These rates were documented on clay tablets that archaeologists have translated. They are not estimates or approximations, they are receipts. So who was the temple lending for? Not for the farmers primarily. The farmers needed grain and paid dearly for it. The temple accumulated surplus wealth from every transaction. The priests administered that wealth. The rulers who controlled the temples received a share of everything. The ordinary citizen who needed a grain loan to survive until harvest was the engine of the system, not the beneficiary. This is the original banking relationship. The institution holds assets. The institution lends those assets at interest to people who need them. The institution profits. The borrower pays more than they received and hopes the return on what they did with the loan covers the cost. That relationship has not changed in 5,000 years. Only the building changed. The temple became the bank branch. The priest became the loan officer. The grain became currency. The clay tablet became a digital ledger. The interest rate on a Sumerian grain loan and the interest rate on an American credit card are within a few percentage points of each other across 5 millennia. The Code of Hammurabi, carved into a stone stele around 1754 BC in Babylon and now sitting in the Louvre in Paris, contains 282 laws. Historians quote it mostly for its justice provisions. An eye for an eye, a tooth for a tooth. About a third of those laws deal with debt, lending, and commercial transactions. Hammurabi set maximum interest rates. He created rules for what collateral could be seized. He established procedures for debt disputes. He outlined consequences for lenders who charged above the legal rate. The reason a Babylonian king needed to legislate debt so extensively is that debt had already become a serious social problem by 1754 BC. Citizens were losing their land and their families to creditors. People who could not repay their debts forfeited their freedom and their labor to the creditor until the debt was worked off. Hammurabi's code set a maximum of 3 years for this arrangement. The gap between those who held credit and those who needed it was tearing Babylonian society apart. Hammurabi's response was not to dismantle the lending system. It was to regulate it just enough to prevent the kind of social collapse that would destabilize his own rule. Maximum interest rates, a 3-year limit on debt bondage, specific protections for widows and orphans against aggressive collection. He was not protecting borrowers out of compassion. He was protecting the system from itself. A population that loses everything to creditors eventually stops functioning as a productive society and starts demanding change. Hammurabi understood that lending needs enough regulation to survive, not enough to be fair. Every financial regulation debate since then has had the same shape. Banks push for maximum freedom to lend at maximum rates. Governments regulate just enough to prevent social instability. The borrower sits in the middle and negotiates with neither side on their behalf. The Consumer Financial Protection Bureau in the United States was created in 2010 after the financial crisis. It was the most significant consumer financial protection legislation in decades. It has been under sustained legal and political attack from the financial industry every year since it was created. The pattern Hammurabi established in 1754 BC is still running. Here is where the story takes a turn that most banking histories skip entirely. Ancient Mesopotamian rulers periodically canceled all debts, not some debts, all of them. These were called clean slate proclamations. The Sumerian word is Amargi. It appears on clay tablets from around 2400 BC, and it is the first known word for freedom in any language. Freedom and debt cancellation were literally the same word. The same concept. The scribes who invented writing looked at their world and decided that the most important thing freedom could mean was not owing anything to anyone. These cancellations happened at the start of a new king's reign. They happened during famines. They happened when social instability reached dangerous levels. Rulers canceled agricultural debts specifically, the debts held by ordinary farmers who had borrowed grain or silver to survive and could not repay. Commercial debts between merchants were generally left intact. The anthropologist David Graeber spent years documenting this pattern across ancient Mesopotamia, Egypt, and the classical world in his 2011 book, Debt: The First 5,000 Years. He found clean slate proclamations across multiple civilizations across multiple centuries. The pattern was consistent. Debt accumulates, social pressure builds, authority cancels the debt and resets the clock. The last time anything resembling this happened in the modern Western world was the Jubilee 2000 campaign that pushed for cancellation of debt owed by developing nations to the International Monetary Fund and World Bank. It achieved partial relief for some of the poorest countries on Earth after years of lobbying. For ordinary citizens in the United States and Europe, no such mechanism exists. Bankruptcy is the closest equivalent, and it is a legal process primarily designed to protect creditors, not debtors. It follows you for 7 to 10 years on your credit report. It does not cancel most student loan debt in the United States, regardless of circumstances. The ancient mechanism that recognized debt could reach a point where it simply needed to be erased has no modern equivalent for the people who need it most. Move forward about 2,000 years to ancient Greece and Rome and watch the system develop two features that define your experience of banking today. The first is moralizing. The ancient Greeks had a complicated relationship with lending. Aristotle argued in his Politics that charging interest on money was unnatural. His word for it was crematistic, money breeding money, and he considered it philosophically indefensible because money is sterile. It does not grow the way grain grows. Charging for its use was, in his view, extracting something from nothing. The Romans were less philosophical about it. They built one of the most sophisticated credit systems the ancient world had seen. Roman banking families operated across the empire. Letters of credit allowed merchants to access funds in different cities without physically transporting coins. Interest rates fluctuated with supply and demand. The Roman financial system at its height was more complex than anything Europe would see again for centuries after the empire collapsed. But Rome added something to the moral vocabulary of debt that has never left. The Latin word for debt is debitum. It shares its root with the word for sin in early Christian translations. When early Christians prayed for forgiveness of their debts as they forgave their debtors, they were using financial language to describe moral failure. Debt and sin became linguistically tangled in Latin, and that tangle spread into every European language that descended from it. The shame that people feel about personal debt today is not a natural human response to owing money. It is a Roman Christian moral framework layered onto a Babylonian economic system. The shame serves a function. Ashamed debtors do not organize. They do not demand cancellation. They do not discuss their debt publicly. They pay in silence because they believe their debt reflects something wrong with them personally. This is useful for the institution holding the debt. A borrower who believes their debt is a moral failure is far easier to manage than a borrower who understands their debt as the product of a system designed to keep them indebted. The second feature Rome contributed was the concept of banking as a separate profession from government and religion. Roman argentari were private bankers. They accepted deposits, made loans, and facilitated currency exchange. They operated as private businesses rather than temple institutions. The separation of banking from the temple was a significant structural change, though it did not change who the system served. When Rome collapsed in the West, the financial infrastructure collapsed with it. The Catholic Church filled the vacuum, and the Church officially banned usury, the charging of interest, for Christians under canon law. This sounds like the debt system finally meeting a genuine moral check. It did not work that way. The ban applied to Christians. Jewish merchants were outside canon law. Italian merchant families found legal structures that technically complied with the usury prohibition while achieving the same financial result. The Medici banking family in Florence built the most sophisticated financial institution in medieval Europe and found ways around the church's prohibition at every turn. The Medicis invented the letter of credit that moved money across Europe without physically transporting it. They invented double-entry bookkeeping, the accounting system that every business on earth still uses. They lent money to popes, to kings, to the Holy Roman Emperor. When Edward III of England defaulted on loans from the Bardi and Peruzzi banking families in the 1340s, both banks collapsed and took a significant portion of the Florentine economy with them. A single sovereign default destroyed two of the largest financial institutions in Europe. The concept that a government could borrow so much from private banks that its default could collapse those banks was not a modern discovery. It was a 14th century lesson that nobody in finance has ever fully learned from. The Bank of England was founded in 1694 with a specific purpose. It was not founded to serve English citizens. It was founded to lend money to the English government to finance a war with France. A group of private investors agreed to lend the government £1.2 million in exchange for the right to issue banknotes and charge interest on the loan. That transaction is the direct ancestor of every modern central banking system. A private institution lends to the government at interest. The government repays using tax revenue. The institution profits from sovereign debt. The citizens pay taxes that service the debt and have no say in the terms of the arrangement. The Federal Reserve in the United States operates as a central banking system with both public and private elements. When the Federal Reserve purchases government bonds, it is using the money supply it controls to hold the debt of the state and earn interest on it. This arrangement was established in 1913 and continues today. Your taxes contribute to government debt repayments that flow through the banking system. This is the publicly documented structure of modern sovereign finance. The Bank of England established this model in 1694. The Medici banking families were operating a version of it in the 14th century. The Babylonian temples were running the original version 5,000 years before that. Now look at what your bank actually does with your money when you deposit it. When you deposit $1,000 in a bank account, your bank does not hold $1,000 in a vault for you. Under the fractional reserve banking system used across the developed world, your bank is required to keep only a fraction of your deposit in reserve, historically around 10%, though the Federal Reserve reduced required reserve ratios to 0% in March 2020 and has not restored them. Your bank lends out the rest, multiple times over, through the mechanics of the money creation process. Your deposit of $1,000 can generate significantly more than $1,000 in loans across the banking system. The bank earns interest on those loans. You earn a fraction of a percent on your savings account, if anything at all. This is not fraud. It is legal. It is documented. It is how the system works. The Babylonian temple that took in grain deposits and lent out more grain than it held in storage was operating on the same logic. The temple had enough grain to cover likely withdrawal demands. It lent the rest and profited from the difference. The Babylonian farmer who deposited grain with the temple understood he was getting safekeeping in exchange for the temple using his grain productively. The modern depositor signs a terms of service agreement that most people never read and does not understand that their deposit is being lent out at rates several thousand% higher than the return they receive on it. The information gap between the institution and the customer was built into the system at the beginning. It has been maintained ever since, not through active deception, through complexity, through legal language, through a financial education system that does not teach how banking actually works. Here is the part I find genuinely difficult to shake. The people who built the first banks were not trying to help. They were trying to accumulate. The temple priests of Sumer accumulated grain and silver. The Medici accumulated political power and papal influence. The founders of the Bank of England accumulated the right to create money. Modern banks accumulate assets, market share, and the fees generated by millions of small transactions. Every time the system has been reformed, it has been reformed just enough to survive and continue accumulating. Hammurabi regulated interest rates to prevent social collapse. The church banned usury, and the bankers found legal workarounds. Regulations separating commercial and investment banking introduced in the 1930s were later removed in 1999. New regulations introduced after the 2008 financial crisis have faced ongoing pressure from the industry since their passage. The cycle is the system. Accumulation, crisis, minimal reform, accumulation again. None of this means you should not use a bank. The practical reality is that participating in modern economic life without one is nearly impossible. Direct deposit, bill payment, credit access, mortgage qualification, all of it runs through the banking system. Opting out entirely is not a realistic option for most people. What changes when you understand this history is how you relate to your bank, not as a partner in your financial well-being, not as an institution built to serve you, as a 5,000-year-old accumulation machine that you need to navigate carefully because it was designed by people who were thinking about themselves. The priest who built the first bank in Uruk in 3400 BC was not thinking about the farmer who would need a grain loan. He was thinking about the temple. The bank branch that approved or declined your last loan application was not thinking about your life. It was thinking about risk, return, and its quarterly targets. Understanding who built the system and why they built it does not give you power over it. But it does give you something the system has always preferred you not to have. An accurate picture of what you are actually dealing with. That picture has been available for 5,000 years. It was just written in cuneiform on clay tablets in a dead language in a country most people cannot find on a map. Now you have it in a language you speak. Use it accordingly. One last thing worth saying, because there is a detail hiding at the end of this story that almost nobody talks about. The word bank does not come from a financial term. It comes from the Italian word banca, meaning bench. Medieval Italian money changers sat at benches in public markets and exchanged currencies, made loans, and kept records. When a money changer could not meet his obligations, his bench was broken by the authorities. The broken bench, Banca Rotta in Italian, is where the English word bankrupt comes from. The entire vocabulary of modern finance traces back to a man sitting at a wooden bench in a market in medieval Italy. Before that, it traces to a Roman Argentarius working from a table in the Forum. Before that, to a Babylonian scribe recording grain transactions on a clay tablet in a temple courtyard. The technology changed at every step. The relationship between the institution and the person across from it did not. The money changer at the bench knew which currencies were undervalued. The borrower sitting across from him did not. The Roman banker knew the real interest rate on a complex financial instrument. The merchant who needed the loan did not. The Babylonian temple priest knew that compound interest would double a debt in 3 years. The farmer who needed the grain did not. The institution has always had more information than the person across from it. That asymmetry was not an accident of complexity. It was the original design. You cannot charge 33% interest to someone who fully understands what 33% interest does to a debt over time. You can charge it to someone who just needs grain before the harvest and thinks they can pay it back easily. 5,000 years later, the instrument is a credit card application with a 40-page terms of service document. The asymmetry is the same. The bench is just made of glass and steel now and sits on a high street instead of in a market. The man at the bench is still deciding whether you qualify. He always was. So what do you actually do with everything you just heard? Not philosophically, practically. Because understanding 5,000 years of banking history is only useful if it changes something about how you move through the system today.